Welcome to Yadnya Investment Academy. Many a times it has been experienced that people believe dividends in case of mutual funds and stocks to be same, and they get lured by dividend announcements in case of mutual funds and invest into them. But dividends in case of mutual funds and that of stocks are not same. And in this video, we are going to see how exactly that is. You buy a stock due to its capacity to generate returns for you. One is through appreciation in its value in the market. Another is through profit sharing through dividends. At times, the company might not want to give away dividends. It might want to reinvest this profit. This leads to increase in the intangible value of the company. The results of reinvestment are not evident until and unless it leads to increase in the stock price in the market. But when you get dividends, you make gains over and above the standing value of the stock in the market. Dividends in case of stocks is like one of those free items on a thing you want to buy with no extra cost. Let us take an example. Let us say you bought a stock at rupees 70 per share. Due to the demand and supply equation of the market, the price of the stock increases to rupees 100. Now, whatever profits the company makes may or may not be distributed amongst its investors. Let's say the company wants to distribute its profits and announces a dividend of rupees 10 per share. Now, whenever a company announces a dividend, it has to pay a dividend distribution tax, which is 20% on the dividend amount. After deducting this tax from the dividend amount, you get an in-hand dividend of rupees 8, which is completely tax-free for you. And when you're earning these rupees 8 per share, still there's no impact on the value of your stock in the market. It still trades at rupees 100. And this is why people are very happy whenever a stock declares dividends, as they make gains over and above the value of the stock. In case of mutual funds, if your mutual fund is an equity mutual fund, the dividends are tax-free for both mutual fund as well as the investors. But in case of debt funds, dividends are tax-free for the investor, but the mutual fund house has to pay a dividend distribution tax, which is applied at 28.84% on the dividend amount. Due to this huge dividend distribution tax, it is always better to go for growth option than the dividend option, even in case of debt mutual funds. Watch our video on dividend versus growth mutual funds, which elaborates how dividend option is better than growth option only in one case, where the investment duration is lesser than 3 years and where the taxpayer is in the 30% tax bracket. We have already seen through our example in case of stocks that receiving dividends is like getting something over and above the standing value of your stock in the market. In case of mutual funds, on the other hand, getting dividend is like partly redeeming your investment. Let us see how. Let us say you have invested into a mutual fund where the NAV of the mutual fund is rupees 100. At this point in time, the mutual fund decides to distribute a dividend of rupees 10 per unit. Now, after dividend distribution, the NAV of the mutual fund comes down by the dividend amount. So, the new NAV is rupees 90. Let's say you've had 100 units of this mutual fund. So prior to dividend distribution, the value of your holding would be 100 multiplied by the NAV, that is 100, so 10,000 rupees. Now here, due to your 100 units, you've received a dividend of rupees 1,000 on your investment. After dividend distribution, the value of your 100 units would be 100 multiplied by the new NAV, which is 90. So the value would be 9,000 rupees. And you've received a dividend of 1,000 rupees. So this adds up to 10,000 rupees, which was the value of your holding before dividend distribution. So getting these 1,000 rupees into dividends is like selling 10 units of your holdings. It's like partly redeeming your investment. Here it is important to understand that a dividend payout reduces the magic of compounding the small dividend amount could do on your profits. And the amount that is distributed as dividend is too small to actually serve the purpose of a source of income, unless the amount invested is huge and your need is too small. There is one instance where dividend can actually be called good. That is, in case of equity mutual funds, in a rising market, mutual fund may declare dividends to reduce the impact of market correction on the value of the mutual fund portfolio in an already heated market. So friends, in this video we have seen how dividends in case of stocks are like freebies and that in case of mutual funds are like partly redeeming your investments. If you're looking at dividend option in mutual funds for a regular source of income, systematic withdrawal plan could be a better idea. Watch our video on systematic withdrawal plan to understand that concept. So the next time you're lured to invest into a mutual fund due to the dividend announcements it makes, think again. Friends, thanks for watching this video. Watch this space for more such topics. Until then, happy investing.